How do the rising capital and risk management requirements imposed on banks in 2024 affect your life and the economy? Could cryptocurrency offer a solution? This intriguing question has been igniting discussions, sending ripples throughout the banking sector, and let's delve into this a tad deeper. Today's regulatory environment is highly dynamic, with the Bank for International Settlements, or BIS, and multiple government bodies joining forces to guarantee the stability of the financial ecosystem. One of the major shifts they initiated in 2024 is the surge in capital requirements for banks. So the implication here? To put it simply, these capital requirements refer to the bare minimum of capital a bank is obliged to hold in proportion to its risk-weighted assets. They serve as a cushion, shielding the bank from financial and operational risks. The purpose is to ensure that banks are sturdy enough to weather economic storms, thereby safeguarding consumers' interests and the overall economy. Now, information from the BIS and government bodies indicate that the magnitude of these changes is pretty large. We are not discussing a minor adjustment here and there, but a significant escalation in the capital that banks need to hold. This places considerable burden on banks, particularly those that are smaller or more inclined to risks. They are now in a race against time to fulfill these new requirements, which can be a formidable task. Heightened capital requirements aim to stabilize banks and protect consumers. However, they also pose hurdles to banks. Banks might need to cut down on lending, hike interest rates, or explore other avenues to generate capital. This can trigger a domino effect on varying sectors of the economy, from consumer lending to the real estate market. Hence, these regulatory reforms are a double-edged sword. While they strive to fortify the banking sector and safeguard consumers, they also exert pressure on banks and could potentially affect the economy. It's a delicate equilibrium that regulators need to maintain. Let's delve deeper into how these regulatory changes could affect different sectors of the economy and explore the potential role of cryptocurrency. We'll be discussing this next, so stick around. Imagine the impact on your ability to borrow money when banks face higher capital requirements. As federal regulators ramp up capital and risk management requirements for lenders, banks will have to adjust their strategies. This will particularly affect consumer lending, a pivotal point in the financial ecosystem. So, let's delve a little deeper into what this means for you and I. Firstly, banks may tighten their lending standards. Higher capital requirements mean that banks must hold more money in reserve against potential losses. This reduces the amount they have available to lend. Consequently, they'll be more cautious about who they lend to. The days of easy credit may be numbered, with loans becoming harder to get and lending standards becoming more stringent. Secondly, we could see an increase in interest rates. To compensate for the higher capital requirements, banks might raise the cost of borrowing. This could translate into higher interest rates on loans and credit cards. So, not only could it become more difficult to get a loan, but it could also become more expensive to borrow money. Now let's talk numbers. While it's hard to predict exact figures, banking sources suggest a potential reduction in consumer lending. If we look at historical trends, similar regulatory changes in the past have led to significant reductions in lending. It's reasonable to expect a similar pattern this time around. So what does this mean for consumers? Well, decreased access to credit could lead to less spending and investment. Higher borrowing costs could put a strain on households and businesses alike. This could result in a slower economy and potentially higher unemployment rates. As we navigate these changes, it's important to remember that they're designed to create a more resilient banking system. However, it's equally important to understand the potential ripple effects. As consumer lending takes a hit, the ripple effect on the housing market is inevitable. What happens when the lifeblood of the housing market, credit, becomes more expensive and harder to access? Picture this. The federal regulators, with their ever-watchful eyes, are looking to increase capital requirements for lenders in 2024. This might seem like a well-intentioned move to safeguard our financial system, but let's consider the implications on the housing market. When the cost of credit goes up, banks become more selective about who they lend to. As a result, we might see a slowdown in lending activities. This reduced lending could potentially cause a slowdown in the growth of the housing market. The World Economic Forum's data supports this narrative, indicating a strong correlation between lending rates and housing market growth. Imagine you're an aspiring homeowner, ready to take that big leap into the world of mortgages and monthly payments. But with banks tightening their purse strings, qualifying for a mortgage could become more difficult. This could mean waiting longer to buy a home, or perhaps settling for something less than your dream house. But it's not just home buyers who could feel the pinch. Home sellers too could face challenges. With fewer qualified buyers in the market, selling a house could take longer. And in a worst-case scenario, sellers might even have to accept lower offers. This slowdown in the housing market could have broader impacts on the economy. The housing market is a significant contributor to economic growth. It creates jobs, fuels consumer spending, and generates tax revenues. So, a slowdown in this sector could be a speed bump on the road to economic recovery. The ripple effect doesn't stop at the housing market. Let's see what might happen to the banking landscape itself. With the increased pressure from higher capital requirements, will regional banks bow out, paving the way for the Big Four? The winds of change are blowing across the financial landscape. As federal regulators toughen up, imposing higher capital and risk management requirements, regional banks find themselves in the eye of the storm. The question looming large is whether these smaller players will be able to weather the storm, or will they give way to the dominance of the Big Four? Data from the Bank for International Settlements and numerous banking sources suggest a potential consolidation in the banking industry. The increased capital requirements could push regional banks towards mergers and acquisitions, resulting in fewer but larger entities. This consolidation might indeed reduce the number of banking options for consumers, increasing their reliance on the Big Four: JP Morgan Chase, Bank of America, Wells Fargo, and Citigroup. But what does this mean for the consumer, for you and me? Well, reduced competition could lead to increased banking costs. The Big Four, with their extensive reach and resources, could monopolize the market, dictating terms and prices. This could potentially lead to higher interest rates on loans and reduced interest payouts on deposits. On the other hand, consolidation might also lead to improved operational efficiency and stronger risk management, as larger banks have more resources to invest in technology and risk assessment tools. This could in turn lead to more stable financial systems. However, the potential implications of these changes go beyond banking. The increased dominance of the Big Four could have far-reaching effects on the economy as a whole. The fate of regional banks, therefore, is not just a question of banking. It is a question that touches all corners of our economic lives. The future of banking may be reshaped by these regulatory changes, with implications for us all. The increased capital and risk management requirements for banks in 2024 are not just numbers on a balance sheet, they are catalysts for change. As we've explored in this discussion, the implications of these regulatory adjustments are far-reaching and multifaceted. First and foremost, consumer lending stands on the precipice of significant transformation. With increased capital requirements, banks may well be more cautious in their lending practices, potentially leading to tightened credit conditions for consumers. This, in turn, could affect consumer spending, a major engine of any economy. Next, we've seen how these changes could send ripples through the housing market. If credit becomes more difficult to access, home purchases could decline, potentially leading to a slowdown in the housing market. This could have profound implications not only for prospective homeowners, but for the broader economy as well. On the banking industry front, the fate of regional banks hangs in the balance. As these smaller institutions grapple with increased capital and risk management requirements, they could find themselves in a precarious position. The possibility of regional banks shutting down in favor of the Big Four is not something to be dismissed lightly. The FDIC can only cover so much, and the potential disruption to the banking landscape could be substantial. But let's remember, these changes, while challenging, are not necessarily negative. They are, in essence, measures designed to fortify the financial system against future crises. They aim to ensure that banks have enough capital to absorb losses and continue operations during tough times. In navigating these changes, understanding is key. It's crucial to comprehend the potential implications of these regulatory shifts, not just for the banking industry, but for the wider economy and our everyday lives. In this ever-changing financial landscape, awareness and understanding are our best tools. Stay informed and stay ahead. Scene 6. Cryptocurrency as a hedge. In the wake of increased capital requirements for banks, one cannot help but ponder, could cryptocurrency offer a significant hedge for the general public? For the uninitiated, cryptocurrencies are digital or virtual currencies that use cryptography for security. They are primarily decentralized systems that allow for transparent peer-to-peer transactions to take place online. The decentralized nature of these digital currencies means they are not subject to the same regulatory frameworks as traditional banks, including the increased capital requirements we've been discussing. This could potentially offer a hedge against the risks associated with traditional banking. For instance, in a scenario where banks are cautious about lending due to increased capital requirements, cryptocurrencies could step in to fill the void, providing alternate avenues for borrowing. Moreover, cryptocurrencies have the potential to provide financial services to those who are unbanked or underbanked. Around the world, there are billions of people without access to traditional banking systems. Cryptocurrencies, with their decentralized nature and accessibility, could offer these individuals a chance to participate in the global economy. However, it's important to remember that while cryptocurrencies offer potential advantages, they also come with their own set of challenges, including price volatility and regulatory uncertainty. As we continue to navigate this changing financial landscape, cryptocurrencies may offer new opportunities, but also pose new challenges. It's essential not to view them as a panacea, but as another tool in our financial toolbox. Stay informed, be aware, and remember, knowledge is power in this evolving financial world.